morning and welcome to Market Cafe. You're on ET Now with me, Lisa Fernandez, and with me I have Snehi Shah. Very good morning to you, Snehi. Yes, and during the course of the next 1 hour, we take you through what's trending both on the international as well as the domestic market. On the domestic market will come on the latter part of the show, but let's start with the international market. Snehi has tracked very closely for us. Snehi, is the rally still continuing in the global market yet?
Good morning, Lisa, and good morning to all our viewers. Well, let's put it this way, that global markets have taken a bit of a breather when it comes to the rally. And let's start by talking about the US markets. Then in stock futures oscillated near the flat line on Thursday evening as investors look to keep this month's gains going. Now, during regular trading, the Dow ended the session lower by just 0.1%, snapping a 4-session run of gains. S&P 500 and Nasdaq Composite managed to hold on to the greens, but very flatly, very nominally, so not doing much anyway. Cisco Systems and Walmart fell after weak guidance, and an important data metric came from the US yesterday. That was the weekly jobless claims. Now, this increased more than what was anticipated. US weekly jobless claims came in at 231,000 last week versus what was estimated to come at 220,000. So it's come higher than expectations. This is basically the unemployment figures that are coming in, and it could be a point of worry for the US economy. Now, all three averages are on pace for weekly gains, and that would mark their third straight positive week. The S&P 500 and the Nasdaq are up more than 2% through Thursday's close, while the Dow is on pace for a 1.9%, so almost 2% rise as well. Soft readings for October's consumer price index and the producer price index carried stocks during the week. Remember, the CPI was flat from the previous month, while WPI dropped 0.5% for the largest monthly decline since April of 2020. Now let's talk about bond yields then. US Treasury yields fell on Thursday as investors digested recent inflation data that could impact the path ahead for the Fed Reserve monetary policy. The yield on the 10-year Treasury was down by 9 bips, around 4.45%, so it's come under the 4.5% mark. European markets, let's shift focus and talk about that. European markets closed lower on Thursday amid a cooling off the positive sentiment seen earlier in the week after the release of positive data from the US as well as China. Now, the Pan-European Stock 600 index closed with a downtick of 0.7%. FTSE was down a solid 1%. However, DAX held on to the positives, was up 0.2%. So, well, Lisa, not much when it comes to the global handover. Largely flat. US markets not doing much. European markets, you could say a little in the negative, but flat. So this is on the equity front. Take us through what commodities have done.
Actually, when crude prices are looking weak today because US crude prices, they fell around 5%, and this is as inventories rose amidst the demand concerns, because the US crude inventory data which came, that rose by 3.6 million barrels last week, while the production that held steady at a record of 13.2 million barrels per day, and this is according to the data which has been released by the EIA on Wednesday. Now, the WTI December contracts, that has fallen by around 5% to settle at $72.9 per barrel. And if I look at the price now, it's at the spot price WTI crude, it's at 72.9, while the Brent Jan contract, that tumbled at around that same level of 5% to settle at $77 per barrel. Now, US crude as well as the global benchmark, that has hit their lowest level since early July. Meanwhile, the data is also coming from China, which actually displays some demand concerns because the crude refining throughput, that has slowed down by 2.8% in October to the equivalent of 15.1 million barrels per day from a record high in September. And this is according to the data from the National Bureau of Statistics, which implies slowing demand in the world's second largest economy, Snehi. So we have to keep an eye on the crude prices because there's a lot of volatility in of late in crude prices as
Absolutely,
well.
some cool off we've seen over there as well.
Right.
With that, let's also take stock of all the events that you need to keep on your radar today. And let's start by looking at some macro cues. You've got India bank loan and deposit growth numbers coming out today. Globally, you've got the UK retail sales as well as the Eurozone CPI, which is the inflation for the Eurozone. Those numbers will be out today as well. Important data points, so keep your eyes on that metric as well. And shifting focus back home, then today is the last day to be eligible for dividend to buy stocks like Page Industries, Anupam Rasayan, Atul, Aurobindo Pharma, Balrampur Chini, Cochin Shipyard, GMM Pfaudler, Kaveri Seeds as well as Mazagon Dock, so a whole host of stocks over there as well. On the corporate action front then, you've got Tata Steel Long that will be in focus because the shares will be suspended from NSE in today's trading session. And when it comes to other events then, you've got the US Congress. The deadline to pass Fed spending measure will be today, so keep your eye out on that as well. And when it comes to Europe then, Christine Lagarde, who's the president of ECB, will be speaking at the European Banking Congress. So, well, lots of cues to keep your eye out for in today's trading session.
Right, and let's move on to some global stories, some gloomy news coming in from Israel. The Israeli strikes continue across Gaza as the enclave went under communication blackout, and this is after the main telecommunication provider ran out of fuel for its generators. On the other hand, Israel's health ministry has alerted that thousands of women, children, injured patients, they are in danger as Israel continues its raid at the Shifa hospital. And in a latest, the Israeli military has claimed an uncovered Hamas tunnel shaft and a vehicle with weapons at Gaza's Al-Shifa hospital complex. So far, at least 11,470 people have been killed in Israeli strikes on Gaza since the war has begun.
Well, let's shift focus then, and Chinese e-commerce giant Alibaba shares tanks as much as 9% after it said that it would no longer proceed with a spin-off of its cloud intelligence group. This comes in after they claim that the US chip export restrictions have made it harder for Chinese firms to get critical chip supplies from US companies.
And on to some earnings front now. Siemens has posted strong Q4 earnings and also gave a strong outlook on the revenue front, expecting a 4 to 8% growth over the next 2 months. Now, meanwhile, US retailer giant Gap has its Q3 results outpacing the street forecast.
And British luxury fashion retailer Burberry shares plunged 9% after the company was hit by a global slowdown in luxury spending. The company warned that the full-year operating profit will be at the lower end of forecast and will also miss its annual revenue projections for low double-digit growth. The company reported a sharp slowdown in comparable store sales growth in its Q2 to 1%, down from 18% in the first quarter as growth in China evaporated.
So those were the global highlights, but with that, let's slip into a short break. But stay tuned on the show as we mark the Asian market after the break.
Hi there, welcome back. You're still watching Market Cafe and this is ET Now. Now let's talk about some news coming in from the government, because the government may allow EPFO to reinvest redemption proceeds. ET Now has learned from sources that the Finance Ministry may approve the proposal of the Central Board of Trustees for the reinvestment of redemption amount in equities. Prakash Priyadarshi filed this report earlier with all the details. Listen into what he had to say.
Yes, we are learning from our sources that the government may allow EPFO to reinvest redemption proceeds into exchange-traded fund. An important development coming in as Ministry of Finance and Ministry of Labour have held an important meeting on this issue. And we are given to understand that the Ministry of Finance may allow EPFO to reinvest redemption proceeds going forward. Therefore, EPFO may reinvest around rupees 13 to 14,000 crore annually into exchange traded fund going forward, and it will also help EPFO to increase its overall investment into ETF to 15%, which is a permissible limit. At present, EPFO is investing around 10% of its overall corpus into ETF. As you are aware that the Central Board of Trustees of EPFO has already given its go-ahead on this proposal, and now Labour Ministry is seeking approval from Ministry of Finance on this proposal. The objective behind this whole process is to earn more return on investment made by EPFO, and it will eventually provide a higher rate of interest to the 8 crore subscribers of EPFO going forward. However, when it comes to enhancement of EPFO's overall investment into ETF or equity beyond 15%, that is something which will be decided by Central Board of Trustees of EPFO first.
Well, thank you for that, Prakash. But the government is only focused on the IDBI bank disinvestments at the moment and not other transaction. Now, this is the word coming in from the Department of Investment and Public Asset Management Secretary Tuhin Pandey. And here's more from that interaction that he had with ET Now.
There is always a target, but the point is that whatever target is fixed 14 months ago in February, that undergoes a change as we say what are the market conditions, and also as we have the transactions fructifying.
Okay, if you talk about the specifics, a few of the transactions which were ongoing were, of course, IDBI Bank, which was on the agenda for past 1.5 years or so. What is the progress there, if you can specify?
The IDBI Bank transaction is on course, and since it's a banking transaction, it really involves the RBI as well. So I think you have a fit and proper issue of RBI, and then we have a due diligence. So it's going on in that direction.
So last question I would ask about what are the other transactions you are looking. You mentioned about the IPO. What are the other transactions you feel that this year will be fructified? And also IDBI Bank, is it happening this year or it will be in next financial year?
No, I mean the transactions, if you are meaning only the strategic disinvestment transactions, because transactions keep happening.
Right.
Now there is a transaction, for example, on IREDA IPO,
right,
which is going to take us this month.
No, that is happening. Sir, I asked about IDBI Bank. Is it happening this year? Is it a possibility?
Well, we can't say that because it's really, conditioned on several factors, which, as I said, that, this was a fit and proper examination by the RBI, which is presently the case. And then there is a due diligence and then financial bidding. So I think it depends upon, how much time all these things. It's a big thing, first time bank transaction happening.
And what happens to the other private banks, sir? We have been hearing for long. The private banks, there are two things. One, there are many public sector banks where you have to necessarily reduce your stake. And sir, other thing you were talking about privatization, out of 12 banks, there was an idea that in future there should be 4 or 5 public sector banks. So on both the things, what is the thinking of the government?
No, we are only talking of IDBI Bank at the moment, because that's one which is cleared by the cabinet.
All right, and let's look at some other news then. The government is looking to divest some non-strategic assets, including companies like NMDC Steel as well as IDBI Bank, the one that we just heard about. That is what we got from the Joint Secretary of DIPAM, Manoj Kumar, as he shared the idea behind this divestment plans and how much that has progressed. Here's an excerpt of that conversation.
Divestment policy of the government is well explained, and as per the policy that we have two sectors, strategic and non-strategic. In non-strategic, we are divesting some companies and they are already in the pipeline.
How much divestment is DIPAM looking for this year?
See that as far as the target you look after the divestment, there is no target as such because it depends on a lot of the factors like the market condition, the appetite of the investors. So there is nothing you can say that we have some target of achieving that because it depends on a lot of other factors.
So do you think that any specific target which is not specific right now, will it achieve, or what are the steps you are taking to achieve it?
See, as I told you, that target is not a correct word for the disinvestment because it depends on a lot of factors, that what is the condition of the, what is the environment of that industry, what is the environment of that appetite of the investors, and because of that there cannot be any target as such for the disinvestment.
So we are here at the ERDA event. What is your big theme here at this event?
See, that big theme about IREDA is that this is a pure renewable NBFC doing a really good job, and as far as the government is concerned, what we are doing in the government, we are trying to list those companies who are really doing good business. So the overall transparency should come and they should be competitive with their own peer groups and others.
And now moving on to an ET Now exclusive, where we have learned from reliable sources that the government will soon be announcing self-governance framework for the startup industry. Now, what this means for the startup world, let's go across to my colleague Bhavya Dua to understand more on this.
Right, so we have learned from our sources that government is soon likely to announce self-governance framework for startups. Now, India G20 Sherpa Amitabh Kant had proposed self-governance for startups earlier in 2023, and government has now set up task force groups which also will have representation from the startup industry. DPIIT and Internal Trade drove this particular initiative, which aims to codify the governance framework for the startups existing in India. Now, these self-governance rules, which will come into force, will have rules for startups codified in over 60 checkpoints, including various aspects of corporate governance. Now, this task force to oversee implementation of the new framework will be set up, and this will happen in cities which have significant startup presence. DPIIT has also held detailed discussions with stakeholders ahead of setting up this task force, and this particular move is intended to boost ease of doing business for startups in India and reduce the red tape.
All right, thanks Bhavya for all of those details. Moving on, then let's talk about Brent crude, because it is at the $77 per barrel mark, which is the lowest level since the month of July. So what are the implications of falling crude prices? Somit is joining in with all of those details. Good morning, Somit.
Well, if you see, Brent crude prices are now trading around the $77 per barrel mark, which is the lowest level that we have seen since July 2023. Now, crude RSI is trading at around 32, so keep an eye out for that, because in the past 3 years, what we have seen is that whenever crude RSI has slipped around the 30 mark, it has always bounced back from those levels. So keep an eye out for that. But currently, if you see, crude is trading below all its key daily moving averages, and so far, crude has dropped around 11% in the month of November 2023, making it the worst monthly performance of crude since August 2022. Now, for the last 2 years also, what we have seen is that always in the month of November, crude has declined around 10% and so far it is down around 11% in the month of November. Now, what has led to this fall in crude oil prices? Now, this is because of signals that is coming in of higher supply in the US, and also because of expectations of weak energy demand in China. Now, the US crude stock rose by around 3.6 million last week, and production continued to remain stable at around 13.2 million barrels per day. Now, this means that there could be higher crude inventories in the US market, and also on the other side, if you see, Chinese oil refiner throughput slowed by around 2.8% in the month of October 2023 from its previous high that we had seen in the previous month. Now, this indicates that there could be some demand concerns also propping up in China, because of which the crude throughput would have been slowed down in the month of October. Now, what to watch out here is that OPEC has a meeting on November 26th, and how they react on this would be important to watch, because their stance has always been to keep crude prices above the $80-85 per barrel mark, and now it has slipped to around $77 per barrel. And OMCs, now that would be largely in focus, because this drop in crude oil prices would aid the marketing margins of the oil marketing companies. Now, because of this drop in crude prices, the gross marketing margin has increased for these oil marketing companies. On petrol, they are earning more than 5 rupees now, and on diesel, they are earning around 2 rupees odd per litre. Earlier, these numbers were in negative when crude was at $97 per barrel. However, one thing that the street is still not factoring is the fact that from $97, the crude has come down to $77 per barrel, which means that there could be significant inventory losses for all the oil marketing companies, and this would impact the oil refiners most in the third quarter. However, that would be a temporary impact, and if crude continues to remain at this level of around $77 or $80 per barrel, then the marketing segment could continue to benefit for the oil marketing companies. Also, GRMs, that is Singapore gross refining margins, have increased from around $1.5 per barrel that we had seen few days back to around $7 per barrel. So, refining segment of the oil marketing companies and standalone refiners also tend to benefit owing to this. So, keep an eye out for oil marketing companies on the back of this sudden drop in crude oil prices.
Well, thank you for that, Somit, sharing your perspective on the crude prices, which has dropped to its lowest level since July. But with that, let's slip into a short break. But do stay tuned as we come back after break with stock-specific news that can be potential buzzers of the day.
Hi there, welcome back. You're watching a Market Cafe on ET Now. Now let's talk about some news coming in from RBI then, because RBI has tightened norms for consumer loans. The central bank has raised risk weight on consumer credit exposure to 125% from the 100% mark earlier. The central bank will also review sectoral exposure limits for consumer credit. My colleague Ankur Mishra is joining in with more details, and after that, senior journalists Tamal Bandyopadhyay and Raman Agarwal of FIDC will also share their views on this. So listen in.
Of India has increased the risk weights on consumer credit of banks and NBFCs. Now this step has been taken in the backdrop of the comments of Reserve Bank of India Governor Shaktikanta Das warning banks and NBFCs about the unsecured credit portfolio. Now as far as the action by Reserve Bank of India is concerned, the risk weights on personal loans has been increased by 25% to 125% versus current norm of 100% for personal loans. The Reserve Bank of India direction for banks excludes housing loans, educational loans, vehicle loans, gold loans. And as far as NBFCs are concerned, the risk weights on consumer credit has been increased once again to 25% to 125%. And the exclusion includes housing loans, educational loans, vehicle loans, loans against gold jewelry, microfinance loans, self-held group loans. These are excluded from Reserve Bank of India's direction. Now, the banks which take exposure in NBFCs, there also the risk weightage has been increased by 25% to 125% wherever that limit is below 100%, and there is also a direction by Reserve Bank of India for regulated entities to review the sectoral exposure limits of consumer credit. The direction says that limit shall be prescribed for all unsecured consumer credit exposure. Now all these steps have been taken for banks as well as NBFCs after that warning which had come from the governor.
Swaminathan, Reserve Bank of India Deputy Governor, he ruled out that any regulatory prescription such as increase in risk weight was considered. That is, I'm talking about in October. Now, what exactly happened in the past 6 weeks that has prompted the Reserve Bank of India to come with this new norm? I don't have any, absolutely, I think this is the way, this is the right way to go, the risk weightage, adding it to it so that you make capital more expensive and discourage them, the lenders, to give low unsecured loans as well as the borrowers, because the cost of money will go up. But what exactly happened in 6 weeks? I mean, why not during the policy itself? I mean, something we are missing out, or RBI is convinced now the bankers are not hearing the warning, they are not paying attention at all.
It has been done uniformly for banks as well as NBFCs. My point again is, why increase the risk weight on bank lending to NBFCs? I mean, that is something which is surprising. While our lending weight, the risk weights have gone up, absolutely fine, going by the market scenario and going by the concerns highlighted by the governor, and that's absolutely fine. But why do it for NBFCs? That will have an impact. And there is one more technical point in the circular, if you read. It says that all top-up loans, even against the movable assets like vehicles, will also be treated as unsecured.
So those were the views on the RBI tightening norms on consumer loans. But how are these set to impact the private PSU banks as well as NBFCs? Because we understand that NBFCs are set to take a big hit. We have Somit here with us to put this impact into perspective. Somit, what are the brokerages talking on this from their point of view? What are they saying?
Well, if you see that RBI has announced this regulatory measures aimed at addressing concerns behind the high growth that we have seen in consumer credit and because of the increasing dependency of NBFCs on bank borrowings. Now, what RBI has done is they have increased the risk weights, and this will be applicable with a retrospective effect, which means that not only it will be applicable on new loans but also on the existing loans. Now, an increase in risk weight for lenders directly impacts their capital adequacy ratio, as they have to set aside a higher capital against such loans. Now, this will also also make loans from more expensive for borrowers. Now, there is a 3-point impact to keep it very simple. Firstly, the CET1 ratio or the Tier 1 ratio of Tier 1 capital will come down for banks and NBFCs. Second, the cost of fund could increase for banks and NBFCs. And thirdly, banks and NBFCs with lower CET1 or Tier 1 capital will have to resort to fundraise for growth going forward. Now, the consensus view coming in from the brokerages is the fact that Bajaj Finance and SBI Card will be most impacted in NBFCs, SBI in PSU banks because it has a lower CET1 ratio, and also other PSUs with lower CET1 ratio would be impacted because of this. And in private banks, they might not have to raise fund because they have a stable CET1 ratio, but they most impacted among them would be RBL Bank, ICICI Bank, HDFC Bank, AU Small Finance Bank, Federal Bank and Kotak Mahindra Bank, because all these banks would see a significant drop in their CET1 ratio. Now, apart from banks and NBFCs, Paytm would also be impacted as it depends on their lending partner, who will now get a bit more cautious in disbursing these unsecured loans. And on the positive side, what brokerages are saying is that secured lenders like Canfin Homes, Aptus Value, PNB Housing Finance, LIC Housing Finance, Home First would be unaffected. And so these could be a tactical bet going forward, given the fact that housing finance is a secured lending, so they won't be impacted because of these new RBI norms.
Thanks for all of those details, but the story does not end here. It's got more legs. Now, banks and NBFCs may approach RBI for further clarity on new risk weightage norms. ET now has learned from sources that the banks want clarity on fixing sectoral limits for consumer loans. Lenders may hike interest rates to offset the impact of higher risk weightage. Ankur Mishra is joining in again with more details. Ankur, take it away.
Yes, sources say that lenders may reach out to Reserve Bank of India on new risk weight asset norms, and these have been released by the regulator after the warning which was given in the last policy. What we have learned through sources is that banks want more clarity on the sectoral limits which has been prescribed as per new norms, and therefore the banks are mulling that they will reach out to Reserve Bank of India and get clarity on the same. Apart from that, NBFCs are worried that the lending which was happening through banks to them may get impacted. In fact, they are worried about increased cost and the source of funding which will get impacted due to these norms. So NBFCs may also reach out to regulator regarding the same issue. As far as the impact is concerned, what we learn is that there are very limited options what the lenders have. Some of the lenders may look to increase rates to offset the impact, but necessarily they have to raise capital for adhering to these norms because the regulator has made clear in the last monetary policy itself that lenders needs to be alert on unsecured loan portfolio, and now it has come in form of action by giving direction to increase risk weight assets to the lenders.
Well, thank you, Ankur, for sharing your perspective on that. Seems like a big news, and where banks and NBFCs will be in focus today. But let's move on to what's happening on the F&O front, and we have Ansh who tracks it closely. Ansh, we saw yesterday that we were trading in that 19,800 range, but then in the last half an hour we saw correction and all that cheer disappeared. So how is it looking for the market today? What are the levels that you're seeing?
Right, so despite Nifty giving away over 100 points of days high in the previous session, it managed to close in green and more importantly above 50 and 100 DMA. So actually 19,850 is a strong resistance, as you can see in the picture as well. Nifty had taken several resistance over here in last 2 months, so it is important for Nifty to cross over this level. More importantly, also mid cap and small cap had touched record high, so overall it was a good session in the previous session. So let's see now what happened in F&O segment. Short covering was seen in Nifty futures with open interest dropping by over 3%. This keeps the sentiment positive. On option front, we saw a very active call buying at 19,900 strike. Nifty is around 19,760 and traders expecting Nifty to climb over 19,800 and also above 19,900. Whereas on downside, strong put writing is seen at 19,700, indicating strong base support over here. Now let's shift our focus to what FIs did. Index futures, they added a 4,200 contract and they covered around 12,000 short contracts. So net to net, we are seeing a net addition of 16,200 contracts on upside. Because of this, FII total long positions also jumped from 20% to 23%, which has been inching up from last 4 sessions. This is very positive for the market. So in a nutshell, data shows good momentum building up with lots of positivity. Only 19,850, 900 is the resistance which Nifty needs to cross to get on a bullish side.
Absolutely, 19,858 to 900 is the Nifty resistance level. Thanks for taking us through that. But amid this current market setup, what do you think will be the stocks that could be potential buzzers in today's trading session?
Right, so SGVN will be the first stock in focus for today's trading session, as the company has signed an agreement with SECI for a 200 MW wind power project. The project cost for this project is around 1,400 crore, and the project is scheduled to start by November 2025. Apart from this, Jyoti Structures will also be in focus, as company's board has approved raising fund up to 400 crore. In addition to that, it also allowed issuance of warrant convertible into equity shares on preferential basis. Moving on to JSW Infrastructure, company got an order worth rupees 4,119 crore for the development of Kenny Port in Karnataka. Apart from this, Technocraft Industries is also in focus, as company has decided to discontinue its Milangi yarn production, which is situated in Maharashtra, on the back of adverse market conditions and financial losses. GlaxoSmith's board has approved a commercial transformation initiative to explore new innovative solutions. DCX System is also in focus, as they have set to raise fund for an aggregate amount of around 500 crore. Lastly, Brigade Enterprise will be in focus, as company has decided to come up with a project in Bengaluru, the project cost for which is 2,100 crore and the size for which is estimated to be around 2 million square feet. So keep an eye on the stocks.
Thanks, Ansh. We'll definitely keep an eye on all those stocks. But let's shift focus on the FMCG sector, because Macquarie has conducted a dealer check on the FMCG sectors. They have identified the demand concerns in select spaces like hair oils, biscuits, as well as soaps. And with this, they also witnessed strength in coffee, carbonated drinks, as well as Ayurvedic products. And Vinny is here with all the details. Vinny?
Absolutely. So let's talk about the channel check that Macquarie has done on the FMCG SPAC. When you look at it, the demand concerns they said are highlighted in some of the sectors, like whether it's oil, biscuits and soaps. And what they're seeing and where they see good strength coming in as of now is the coffee sector, as well as coffee products, carbonated drinks, as well as Ayurvedic products. Other than that, they're saying that they continue to remain cautious in terms of the rural demand outlook, because with the hopes of wedding season, that maybe could drive it in terms of a sequential uptick. But yes, keeping a positive, cautiously optimistic outlook on that front as well for the rural demand. As of now, they're saying they've not seen much of an uptick in terms of competitive pressure from cheaper local players and local brands as well, and continued strength is seen in the urban area, as well as they're hopeful for a rural pickup, like I mentioned before as well. Food segment, that continues to be an outperformer versus the personal care segment. That's the trend that we've seen even in Q2 as well. Seems like that's continuing as of now as well. And in terms of online, offline, the price disparity surely has seen a bit of a concern for something like a Mamaearth as well. Private brands which are owned by Reliance are witnessing a very healthy growth, is what they are highlighting. Let's move on and talk about one specific company that they've highlighted and spoken about from Macquarie, is from Asian Paints. Now they're talking about Asian Paints price cuts. Let's not forget, a lot of competition is increasing in the paint segment as well. And Asian Paints has taken a price cut across its decorative portfolio as well. Rupees 2 per litre price cut is taken for enamels, rupees 3 per price cut is taken for across economy emulsions, as well as rupees 10 is taken across a cut of a waterproofing segment. Overall, the portfolio level cut will be at a marginal of around 1%. That's what Macquarie is saying, and this price cuts will be effective from the November of 15th. So let's keep an eye out on this as well.
All right, Vinny, thanks for that quick take. FMCG stocks will be in focus today on the back of that. But another stock that Ansh had also mentioned that will be in focus today is JSW Infra, because that company has won a bid to develop the Kenny Port with an investment of 4,120 rupees. So let's go across to my colleague Sharad to get all the details on this order win. Sharad.
Well, there's a big order win coming in for JSW Infra, and this is an important multi-cargo port coming in, Kenny, which is in Karnataka. Almost 30 million tons of total tonnage is there, and roughly 4,120 crores would be coming in for this deal. Now do remember, this is just a signed letter of acceptance, and importantly, if you look at the impact, the funding of the project won't be hurting the balance sheet because the company itself is having net cash reserves, and the company itself was recently listed also, where there was debt reduction. Apart from this, also the ROC is likely to be, however, impacted in the short term during the construction of the project itself. And looking at the deal, totally the capex per ton stands at roughly 137 odd crore rupees, which is actually higher than the current numbers for the company, but it's in line with the recent acquisitions which was undertaken. Of course, the Adani Ports acquisition was in focus last time, Gangavaram Port, which came in at roughly 100 crore per million ton, while for Krishnapatnam, it stood at 160 crore per million ton. Now, of course, looking at the stock itself, the stock has been on a tear. From its listing price, the stock is up almost 42%, and from the IPO price itself, the stock has jumped 70 odd %. But of course, the valuations front, that stock has turned expensive when it's compared to its only listed peer, which is Adani Ports, with the valuations coming at almost 12-month forward EV/EBITDA multiple of almost 20 times for JSW Infra, while for Adani Ports it stands at 13 times.
Well, thank you for that, Sharad. And let's shift focus on a sector, Nifty IT, which was the top gainer yesterday. And for that, Mark Mobius, the partner of Mobius Capital Partners, believes that Indian IT will grow amidst the rising hardware needs as well as semiconductor hardware sector. It will be quite interesting to watch. He also touches upon the outlook that he has for the Indian market as a whole. Listen in.
Well, IT generally is going to go stronger in India because of the greater and greater need for the US and Europe and other countries around the world for diversification away from China. Of course, India already is so strong in the software business, so that will continue. But I think the hardware is where India will begin to shine. So it's going to be very interesting to see how many companies in the hardware sector, that is semiconductor hardware sector, are listed in India. Not yet, but it's going to come, and that will be very interesting. We're going to have a good Christmas. But you must remember, in a bull market, there always are corrections, so you have to be ready for those corrections. But at the end of the day, India's in such good shape, such great companies, there's no question that things will continue the way they are, and the market will go higher in the long run with corrections along the way. I'm now in Goa, but I've been to 6 Indian cities in the last 4 weeks, and it's been quite revealing to me to how great the infrastructure building is going on and the incredible vitality of this nation. I think India is going to go from strength to strength.
All right, that's the word coming in from Mark Mobius. So with that, we're completely timed out on this week's edition of Market Cafe. We bid you goodbye, but you don't go anywhere because the market takes all the action ahead.